Hello, everybody. It's Tortoise Investing coming at you today with 5 stocks from 5 different sectors that you can buy and hold forever. Who wants some more dividend love to start their days off? I know I do. If you're new, please join the 285 that have already done so by hitting that big red subscribe button. Super free, super easy to do, and it makes you not miss out on any of the dividend goodness that I put out on a weekly basis, 3 times a week. And make sure to hit that like button down below and comment. It can be any and everything. I love to hear from yins. I love communicating with yins. Let's go ahead and jump into everything. Now, if you came here just for what the stocks are, we're going to be looking at Caterpillar, AbbVie, T. Rowe Price, Qualcomm, and TJX companies. Now, if you just came for what the dividend stocks was, thank you for dropping by. Make sure to hit that like button and subscribe if you haven't already. Now, if you came here for the deep dive analysis, let go. So, Caterpillar. I really like this industrial stock. It's got a free cash flow yield of 5.79%. They have a dividend yield of 2.19% and a payout ratio of 26.63%. So plenty of room for growth and the opportunity for reinvestment into the company. Now, the revenue has been growing since 2020. EBITDA has been growing. The free cash flow on hand has been increasing. Net income's been going up. EPS has been going up. Their debt has been relatively flat, so nothing to complain about there. They've got $25.6 billion in debt. Their EBITDA is $12.34 billion, so it falls within that 3 times range. I always look at my debt to EBITDA ratio and want my EBITDA to be, I want my debt to not be no more than 3 times my EBITDA. So this definitely falls in that range. We take a look at the dividend growth here. Over the last 10 years, been growing at a rate of 8.72%, 5 years, 9%. So it is right there at that 8 to 9% range for dividend growth, which is very nice. You like to see it, very consistent. They're doing share buybacks slowly but surely, and they have the 2020 hiccup that pretty much everything has. Besides that, since 2018. They have kept that return on capital employed right at 13% or higher, which is nice as well. So, yeah, that's your industrial. Next up is our healthcare stock at AbbVie. I like AbbVie a lot, especially at these prices. It did have a recent drop here from 165. Caterpillar's another one that's down. They were at 264 at one point, so I mean, these are down, decent buying opportunities, starting points. Not financial advice, just, educational and entertainment purposes. Anyways, AbbVie got a free cash flow yield of 9.19%. They get a dividend yield of 4.01%. This is still bugged out. Last time I checked on Dividend.com, AbbVie's got a payout ratio of around 55-56%. So, revenue going in the right direction. EBITDA ticking up. Free cash flow, net income, EPS, everything is going where you want it to be going. They got some debt, $59 billion. Their EBITDA is $19.66 billion. So again, this falls into that 3 times range. Right at it. That's very cutting it close. Either or. Another thing I don't like a company that's just going just growing. It's a zombie company. In order to grow, they need to grow their debt. That's what a lot of utilities do. It's the reason I stay out of the utilities. So AbbVie was doing that, but they're paying off their debt, and pretty heavily. Like, they have chopped in to almost $20 billion in debt off their books in the past since 2020. So I mean, they're paying it down pretty quickly. The return on capital employed. Again, they had the 2020 hiccup, but before then, it was reliably around the 15s range, and it looks like it is ticking back up again. So, AbbVie, another one I like. I know that they lost their individual patent rights to their big med here recently, but they've got a lot of things in the pipelines to make up for that and keep that free cash flow generating. Next up is our financials, and this one was kind of hard for me to find a financial that I like because of all the bank turmoil and all the chaos and everything that's going on right now. But I decided on T. Rowe Price. Now, I noticed that the payout ratio there says 0%. Let's go ahead and do this live. T. Rowe Dividend. Gonna go check this out. Right there, dividend.com. The place to go. So their payout ratio is 70%, a little bit on the high side, but not too bad. Will not complain. And this one's down quite a bit too from its highs. If you are looking for a nice little financial stock, yeah, this one's down 52% from its all-time highs. But there's a lot to like about it. Like I said, dividend yield of 4.59%, great compounder. Their revenue and everything seems to be ticking in the right direction. They had their hiccup in 2022 because there was a technical recession last year. So a lot of companies will have their hiccups in 2020 or 2022. But the thing I really, really like about T. Rowe, it's got a high dividend yield, so that's a great opportunity for compounding. But their debt, they don't have any debt. If I'm going to be investing in a financial company right now with all the chaos and all the, the debt ceiling and the interest rates and all that stuff that's going on right now, I don't want them to have any debt. And T. Rowe Price has been doing an amazing job at managing their books. The last time they had debt was, according to this, the last time they had debt was with the dot-com bubble bust. They are doing share buybacks slowly but surely. You always like to see that. And the return on capital employed has pretty much been around 20% forever. It's dipped down to 18, 19 there. But yeah, another really great. I like the company. If this dips below a hundo, I'm not going to lie. I'm probably going to be like, it's going to be hard not to. It's going to be really hard not to. Next up is our tech play with Qualcomm. Qualcomm's got a free cash flow yield of 5.75% and dividend yield of 2.94%. I don't know why this payout ratio isn't showing for some of these. I'll go ahead and look it up just so I can give Jens all the information that Jens would need for these companies. Boop. I think Qualcomm's having a morning. Sorry about that. But 33% payout ratio, not too shabby whatsoever. Again, plenty of room for growth and plenty of room to reinvest some funds back into the business. Now, it did run up to 140 here recently and has dropped back down. But I think at one point, yeah, this thing was in the 180s. So this thing's down about 70-ish%, something like that. Maybe even a little bit more. But, yeah, revenue, EBITDA, net income, EPS, everything's ticking in the right direction. Their free cash flow is going up slowly but surely. They have some debt at $13 billion, but their EBITDA is $17 billion, so I can pay off that debt no problemo. Their dividend yield, I think this has been increasing. Oh my gosh. Let me go ahead and look that up. Boop, boop. Sometimes you have a little difficulties and you got to adapt on the fly. And you know what? That's okay. Because we're still rolling with it. Dividend growth. Oh yeah, their dividend growth for the last 5 years has been increasing at a rate of 5.52%. Looks like they've been increasing it a little bit more as of late, to 8.92%. So that falls right in line with inflation. An inflation-beating dividend increase is what you like to see. Because when was you at a job where you got an 8-9% raise without getting like a huge promotion? That's the thing I love about dividend stocks. But yeah, share buybacks, they're doing those slowly but surely. And the return on capital employed is going up, and it has been above 23% since 2018. So, yeah, they're able to take $1 and turn it into a bit more. And, yeah, company's doing good. I like Qualcomm. It's not my favorite. My favorite is Broadcom, but they are way, way overpriced right now. And rounding out the things of our consumer, we got TJX companies. They got a free cash flow yield of 2.94%, dividend yield of 1.7%, and a payout ratio of 39%. Now, this is one of the closest things to a perfect company in my eyes. Revenue, EBITDA, free cash flow, net income, EPS, everything's just ticking right along. They got more cash than debt on hand. You love to see that. Their dividend has been increasing over the past 5 years at a rate of 16.3%. And it looks like this is increasing too as time goes on, which is just chef's kiss. Love to see it. They were doing share buybacks, but it looks like the company has ran up over the past little bit. But return on capital employed in the high to mid 20s, reliably. Wasn't the 30s. They had their hiccup in 2021, but it happens to all of them. Happens to the best of us. But yeah, that's what I've got for you. Your consumer, your tech, your financial, your healthcare, and your industrial play. I appreciate everyone for dropping by, and as always, if you have not already, please hit that subscribe button and hit that like button and comment down below. I greatly appreciate it. And until Friday, see yins.